efficacious vaccines, we can easily become complacent and overlook the challenges confronting the African region. Even before the COVID-19 pandemic outbreak and its devastating socioeconomic impact on our continent, financing African trade was already a challenge. Trade financing gaps had over the years remained stubbornly high. The latest edition of the annual trade finance surveys, usually carried out by Afrexim Bank and the African Development Bank, and which covered the 3 years preceding the 2020 pandemic downturn, showed that Africa's trade financing gap increased significantly compared to the last review. The survey also found that African trade was significantly underserved, with banks intermediating only 40% of the trade, compared with 80% world trade. But the supply of trade finance across the region is also made difficult by the challenging global trade financing environment. Specifically, large-scale withdrawal of international banks from African correspondent banking services in response to rising compliance costs since the 2008 and to 2009 global financial crisis. The high foreign currency content of African trade finance, including even intra-African trade, and Africa's excessive exposure to global volatility through the commodity price cycles. Although trade finance has proven to be a low-risk asset class, its short-term and transactional nature has emerged as an important risk multiplier, with credit crunches associated with business cycles adversely affecting African trade. In the early days of the COVID-19 pandemic outbreak, tightening global financial conditions triggered massive capital outflows from Africa. Capital outflows from the region exceeded $5 billion in the first quarter of 2020. In fact, most of the outflows occurred between February and March as the pandemic raged. In addition to contributing to a widening of interest rate spread, these massive outflows strained African banks, many of which recorded sharp drops in their net foreign currency assets. This further exacerbated liquidity constraints and undermined the capacity of banks to finance the growth of African trade. While the significant 8 to 10% contraction in Africa's trade in 2020 remains the headline news in major journals, what has remained below the radar is how trade finance, the engine, the oil that helps the engine, performed during the period. The survey we are launching today is the first authoritative document aimed at unraveling that secret. The survey was carried out to understand the dynamics and impact of trade finance on Africa in the wake of the COVID-19 pandemic, and inform ongoing efforts by Afrexim Bank and African Development Bank to further enhance their trade finance support to banks, and together with the UNECA, fashion out other interventions as part of the continent's response to the continental challenges posed by the COVID-19. The data collection covered a period of 4 months during the early months of the pandemic. While the pandemic downturn was felt throughout 2020, April was probably the most dramatic month when global trade and capital flows came to a sudden halt. The 14.3% quarter-on-quarter decline in world merchandise trade in the second quarter of 2020 was the largest on record. The survey is also very comprehensive, both in terms of geographical coverage, representation of banks, and asset coverage. The sample includes small, medium, and large banks. Ownership structure is also very broad and comprehensive, including local privately owned banks, foreign banks, government-owned banks, as well as publicly listed entities. In terms of asset coverage, the participating banks accounted for about 60% of the $1.5 trillion in total assets held by commercial banks in Africa. The balanced approach, the design of the survey ensured that the impact of COVID-19 on the financing of African trade were differentiated across banks and geographical regions for a better calibration of supportive measures and policy responses by continental institutions such as the UNECA, the AFDB, and Afreximbank. The main findings of the survey are summarized in the report, and I believe our colleagues will be reporting on them. But as you know, the report comes out as the first comprehensive study on the impact of COVID-19 on the financing of Africa's trade. To launch this report and reflect on some of the key questions related to the dynamics of the trade finance in Africa in the wake of the COVID-19 pandemic and the measures extended by both sovereigns and African DFIs, plus commercial banks, we have an impressive list of speakers. I will go through them briefly. We have His Excellency Mr. Johannes Gawazab, the Governor of the Bank of Namibia, who is represented today by Dr. Epson Wanguta, the Deputy Governor of the Bank of Namibia. Across the continent and the world, central banks played a key role in the COVID-19 crisis management, adopting flexible measures to promote access to finance and ensure financial sector stability. We will all be looking forward to Dr. Wanguta's insights on the nature of supportive measures extended by the Bank of Namibia to sustain the growth of trade finance in the midst of the unprecedented crisis. We also have Ms. Marvat Sultan, the chairperson of the managing director of the Export Development Bank of Egypt. Egypt, as we all know, is one of the few countries which enjoyed output expansion during the synchronized pandemic downturn. The Export Development Bank of Egypt played a key role in that growth resilience, supporting SMEs through its large network of branches and also providing countercyclical support. The lessons learned from that experience will be very valuable for other countries across the region. Also with us today is Mr. Joshua Oigara, the CEO of Kenya Commercial Bank, one of the largest banks in East Africa, with branches across the sub-region. East Africa is one of the sub-regions where cross-border trade has acted as an absorber of adverse global shocks. We will be looking forward to his reflections and lessons learned from various steps taken by Kenya Commercial Bank to sustain the growth of trade within the ECA during the height of the pandemic. With us today also is Mrs. Bola Deshola, Senior Vice Chairperson for Africa for Standard Chartered Bank, one of the few global banks which continue to serve Africa undeterred by rising costs of compliance on the continent. Since 2011, Standard Chartered Bank has consistently been among the top 4 international banks providing confirmations of LCs issued by African banks. The survey shows that the rejection of LCs increased and correspondent banking relationships were cut during the crisis. We're eager to learn about some of the bold and exceptional measures taken by Standard Chartered Bank to boost trade finance during that extremely difficult period. We also have with us today our friend and partner, Engineer Sombo, the CEO of the International Islamic Trade Finance Corporation. The Islamic Trade Finance Corporation has been a major partner and supporter of Afrexim Bank and the entire continent during the pandemic. With its Arab Africa Trade Bridges program, it's been able to support activities that has helped many countries and financial institutions to manage the impact of the pandemic. And last but not the least, our own Mr. Am Kamel, Executive Vice President for Business Development and Corporate Banking. It was another crisis management year coming just a few years after the end of the commodity supercycle, when the bank had to draw on innovative solutions and counter-cyclical response measures to provide timely support to African exporters and financial institutions. AM has continued to lead the bank's interventions, supporting banks and helping to drive Afrexim Bank's effort to bridge the gap created by the withdrawal of international banks from African trade finance. He has helped to make it possible for Afrexim Bank to onboard almost 500 African banks to be able to provide them correspondent banking services and to provide an aggregate facilities amounting to about $8 billion to gradually begin to cover the gap that departing international banks have left on the continent. Distinguished ladies and gentlemen, the Board of Directors, management and staff of Afrexim Bank are most grateful to these exceptional leaders and would like to thank them as they prepare to take the stage for an insightful exchange with a large and global audience attending this launch. We are indeed very pleased, distinguished ladies and gentlemen, to have with us today such a large number of participants. We are pleased that you could join us during this hectic period and look forward to your contribution to a very timely and relevant debate on the future of African trade and trade finance post-COVID-19. Permit me, distinguished ladies and gentlemen, to reiterate our appreciation to our sister, Dr. Vera Songwe, Executive Secretary of UNECA, and Dr. Akuba Deshino, President of the FDB, for the unique partnership and collaboration in addressing a continental problem. It is this kind of collaboration and partnership that will make it possible for our respective institutions to effectively deliver on our mandates. Finally, thanks are due to my colleagues who worked tirelessly to arrange this event, creating the conditions for a global and robust exchange on a topic with great significance for our continent and beyond. The supply of trade finance supports more than 80% of global trade flows annually and will be key to global recovery in the post-containment phase of the pandemic. I thank you all for your attention and look forward to an exciting engagement this afternoon.
Fantastic, Professor Orama, for those introductory remarks. You've done my job as well. You've introduced the panelists and everyone else. A bit of housekeeping. There's simultaneous interpretation if you click on the globe. I'd also like to say that we'll be sending the report as well as all the presentations in the email following this, following the end of this panel. So which you should be receiving either later today or tomorrow morning. So you'll have the full report and you'll have also the presentations. But before we get to the presentation, I'd like to welcome Dr. Vera Songwe, Under Secretary General at the United Nations and Executive Secretary at the UN Economic Commission for Africa. And for your welcome remarks, please, Dr. Songwe.
Thank you. Thank you very much, Omar. Thank you. Distinguished ladies and gentlemen, excellencies, I think I would stand on the protocols that have been established by my dear brother, President Benedict Orama of the Afrexim Bank. We're here, I think, let's not underestimate the reason why we're here today. This is the first survey of its kind that we have done collectively between the African Development Bank, Making Finance Work, of course, Afri-Exim Bank, and the United Nations Economic Commission for Africa, UNECA, to look at, what has been the impact of COVID-19 on trade finance activities and commercial banks in Africa. Why are we doing this? Let me just start. Afri-Exim Bank and Dr. Rama and the rest will correct me if I'm wrong. So far, since the crisis started, have already on-lent almost $8 billion to SMEs on the continent. This is an amazing amount of resources. We've spent a lot of our time looking for additional resources from the international community. We know that our government's got $5 billion from the Debt Service Suspension Initiative. They're about to get, or they just got $33.6 billion from the issuance of new special drawing rights. We also know that as we talk about this, we've all said, it is the private sector that is going to relaunch our economies. It is the private sector that's going to recreate jobs. As we say that, we need to understand, where are you facing constraints? Where is the trade finance constraint coming from? Where are commercial bank constraints coming from? So we can ensure that you are the bridge between the resources and the jobs. At the end of the day, this is about jobs. It's about reducing poverty. So we needed to understand why, where were the barriers, where were the bottlenecks that needed to be fixed? And that's why this survey was launched. Of course, with COVID, we needed to re-understand a lot of things about our environment, in addition to ensuring that we have the right environment for launching the African Continental Free Trade Area Agreement, for which the Afri-Exim Bank has put already in place a lot of platforms, including trade exchange, clearinghouse platforms to make a business work. So we decided to do this to say, how can we help you more? And how can we together make sure that the advocacy for better trade, better commerce, and better financing on the continent works? We have all read all the reports that say access to finance is difficult for the continent. That's why we can't do it. But this micro study, and I want to call it that, really was about how do we unpack access to finance, unpack the question and say, what is it that we need to do? I think the study will show you as you look at it, and I really do hope you look at it and come back to us with things that you believe need more effort and more support, because both Afri-Exim Bank, ourselves at UNECA, the African Development Bank, and Making Finance Work, yes, we're about reports, but we are also about showing some results because we do things. And so we've seen, of course, a material disruption in trade that COVID-19 has caused. And the question is, how can you fix that? What do we need to do? How can we ensure that some of the security agencies can still, I think at the beginning of this crisis, one of the big issues concretely that we were struggling with was how do you move agriculture products? Could we still guarantee security of transportation of cotton from Niger through Mali and into Burkina Faso and Ethiopia? These are real things because the insurance costs go up because the drivers, we've seen issues around the East African border in terms of trucks getting stuck at different border posts. That adds to business cost. And so what we have done collectively, again, working under the leadership of President Kagame and others, has been to say, let's put up a system, let's put up principles that would allow that these trucks don't spend an extra 3 or 4 days at the borders. So those are the kinds of things that we're doing, in addition to providing you with the additional financing. Some of the work, of course, that Afri-Exim Bank and ourselves are doing is to see, can we recapitalize, increase the capital of the Afri-Exim Bank so that the Afri-Exim Bank can do more. And I do want to ask everybody who is on this call today to support that initiative. We believe that by increasing the capital of the Afri-Exim Bank can lend an extra $40 billion to particularly banks and SMEs for development purposes. It's going to take us $1.5 billion of SDRs. To do that, we have $33.6 billion of SDR. So it's not an enormous ask for what we're going to get out of it. Actually, if we can get to $1.5 billion into Afri-Exim Bank and leverage 40 billion, we get a lot more than we get from all the SDRs. The second fight that we're having is the fight about the developed countries on lending their special drawing rights. For those of you who are not very familiar with what special drawing rights are, is essentially the global community gets together and decides to print new money. Once they've printed the money, they decide who gets what. So it's unconditional money. This time around, the first time that something like this was done was in 2008, when the financial crisis happened. The global community got together. Of course, the 2008 financial crisis hit the advanced economies the most, and they created $280 billion for themselves to help respond to the crisis. This time around, they're creating $650 billion. We're going to get 33.6. We're asking them to on-lend some of theirs because they've given themselves over $15 trillion of stimulus so far. So they don't need the SDRs as much as we do for more liquidity, for more access to private sector resources. So this is a big part of it. And we hope that we can use some of those SDRs to increase the capital of Afreximbank. And we hope that particularly you, central bank governors, ministers of finance, ministers of trade and economy that are with us on this call, and captains of industry, I think this is an important point, because then Afreximbank can continue to lend more to you, and the rest of us can hopefully continue to support the work that's being done under the African Continental Free Trade Area Agreement. One of the things that we've seen, of course, and we're working on this, a lot of the central banks and a lot of the banks across the continent, as the COVID-19 begins to unravel, we will begin to see NPLs go up. We would see a lot of more banks becoming more risk averse, because you're not going to be sure about what businesses are going to be viable and which ones will not be viable going into the future. I think these are some of the things that the report is showing you, the survey is saying. We now need to sort of say, how do we do this? What should we do to come about and fix this? And I think also when the crisis started, we had conversations around supporting the tourism industry, supporting the airline industry, supporting the PPE industry. All of that, we hope, was to reduce some of the risk aversion that you as banks will have when you're lending to those sectors of the economy. So we hope, again, that these two activities can come together, some additional support early on to sectors of the economy that you will be lending to, but also that we help to reduce your risk aversion so you can continue to lend. So rather than getting into a vicious circle, we get into a more virtuous circle that recreates the jobs. Of course, a big issue around the crisis is going to be, and the report talks about that, is the issue of institutions, regulatory reform, and how we're going to ensure. I just talked about the NPLs, but capital adequacy ratios, what is going to happen to a lot of this, what kinds of documentation we need. The Afreximbank has been doing a lot of work on automation of some of the processes. We hope we can continue to do that. In collaboration with Afreximbank, ECA, EcoNet, we set up the African Medical Supplies platform, which begins to show us that we can do digital commerce, we can improve our trade processes and reduce the number of paperwork that is needed. The French would say dématérialisation, just to make sure that you can streamline, increase transparency, and hopefully reduce cost, which are some of the things that are coming out of the report. So we're already doing some of the things we see in the report. Some of them we didn't know about, and we hope that together with you, we can structure responses to them that will help us to improve on our trade and access to finance environment on the continent. We need that. Before the crisis, we were looking for 13 million jobs a year for youth that we're getting into the job market. That number is going to increase post-crisis. So we need to ensure that we can give you the financial resources that you need, or put the financial resources needed in our economies so that we can create jobs. The only way out of this crisis is through jobs. The first way out of this crisis is through vaccines. And of course, there's a lot of conversation over the last 2-3 days with WTO, with Africa CDC, with the African Union on how you finance pharmaceutical manufacturing and vaccines. And we hope that part of this is also going to be that we look at how we can fund that. Once we get the vaccines and we're all vaccinated, and hopefully we should be vaccinated, AstraZeneca, Johnson & Johnson, they are all much better than looking for a ventilator. I say, if you have the choice between betting on whether you will get a ventilator when you get to the hospital and getting vaccinated, I would say, please get vaccinated and then worry about the rest later. So a lot of the work that we've been doing is on vaccines as well. And we hope that with vaccines in place, hopefully Africa also gets vaccinated by the end, or at least by the middle of 2022, that we can reopen our economies and use the results of this survey to ensure that we do it in a way that works for you, creates jobs, and delivers prosperity for the continent. So once again, I want to thank the Afreximbank for joining with the Economic Commission for Africa to do this, and for the long partnership that we're having. Thank you very much for listening.
Fantastic, Dr. Vera Songwe. Well, you raised a lot of issues there. I don't think we'll be able to tackle them all, but thank you very much for your interventions. And we'll go straight into the presentation of the Trade Finance Survey. So we've got Dr. David Luke, who's the coordinator of the African Trade Policy Center at the UN Economic Commission for Africa, and Gwen Bwaba, who's Director of and Global Head of Trade Finance at the Afrexim Bank. But we'll start with Dr. David Luke, if you can give us the introduction and context of the Trade Finance Survey. And maybe we can put the presentation, the tech team. Thank you. So Dr. David Luke, the floor is yours.
Thank you very much, Omar. Excellency EC Executive Secretary, Dr. Sogwe, Excellency Afrexim Bank President, Professor Orama, Excellencies, members of the panel, distinguished ladies and gentlemen, all protocols observed. The purpose of carrying out the study on making finance work for Africa, on which the report was, on which this report is based, was to understand how the COVID-19 pandemic impacted trade finance on the continent. As we all know, global output, which was forecast to expand by 3.3% in 2020, actually contracted by 3.5%, and Africa entered its first economic recession in 25 years. Similarly, global trade, which was forecast to expand by 2.7%, contracted by 9.2% in 2020. The poor performance in global growth and trade was particularly significant in the second quarter of 2020, when the implementation of containment measures brought the world economy to a sudden stop and triggered massive capital reversals from emerging and developing market economies. These outflows strained African banks, many of which recorded sharp drops in their net foreign assets, exacerbating liquidity constraints and undermined capacity to finance the growth of African trade. So in order to understand how COVID-19 affected trade finance in the continent, especially during the first quarter of 2020, a survey of commercial banks was carried out across the continent. The overarching objective of the survey was to understand how the COVID-19 global crisis affected the dynamics of trade finance in Africa, which we know is a region that is characterized by a significant trade finance gap. We wanted to make sure that the policy actions that would help banks to have adequate access to trade finance, to sustain trade flows, and accelerate the process of economic recovery post-COVID-19 was based on evidence. The survey covered the first 4 months of 2020, which was the height of the pandemic downturn, when global trade contracted by over 5%. Now, in terms of coverage, the survey targeted more than 370 commercial banks, of which which are involved in trade finance across the continent, and achieved a response rate of more than 50% with a balanced geographical coverage. In terms of assets coverage, the participating banks accounted for about 58% of the 1.5 trillion in total assets held by commercial banks in Africa. So with this introduction, I'll now turn the presentation over to our colleague, Ms. Gwen Bwaba, Director and Global Head of Trade at Afrexim Bank, who will take us through the survey results, and I'll come back to give some more comments on the way forward and the policy implications. So over to you, Gwen.
Thank you very much, Dr. Luke, and a very good day, Your Excellencies, distinguished ladies and gentlemen. I will now take you through very quickly the scope of the survey, the findings of the survey, as well as a summary of the key takeaways. So our sample size for the survey constituted a total of 370 African banks, and we had a response rate of 50% made up of 185 banks. And as introduced by Dr. Luke, the asset coverage was around 57%, and we had responses from each one of the key regional economic blocks of Africa. Okay, Tech, I just need control of the slides, please. Thank you. Okay, so as part of the scope of the survey, the distribution of the respondents was quite well balanced, and it constituted small, medium, and large financial institutions in Africa. And also there was diversity in terms of the respondents, in terms of the type of ownership, which ranged from locally owned financial institutions, private foreign-owned financial institutions, and majority government-owned financial institutions. And we had a small sample of publicly listed banks as well. Now, globally, the crisis has tended to drive increased demand for LCs. However, in the case of Africa, the information we got from our respondents is that 38% had actually experienced a decrease in demand for LCs, and 27% reported that they had seen an increase, whilst 34% indicated that there was absolutely no change. The survey has also highlighted some significant variations in terms of the reasons why there's been an increase in rejection of LCs. And nearly 30% of respondents have reported higher rates of rejection year on year, even during the early stages of the COVID crisis. In Southern Africa, 48% of respondents reported an increase in these rejection rates, whilst in North Africa, 92% of the respondents reported that the situation had remained largely unchanged. Over 38% of local privately owned banks have reported an increase in rejection rate, whilst 30% of foreign privately owned banks did, and just over 10% of a small sample of government-owned banks also reported an increase in rejection rates. The reasons have varied, but what came out quite clearly was that there was two key drivers to these rejections. The first was access to foreign currency. Africa is largely trading in US dollars. And also there was a reduction in correspondent bank appetite for African risk. We asked respondents what their expectation was in terms of an increase in intra-African trade in the health, pharma, and food segments due to COVID-19. 63% of respondents said that they did not expect that COVID would lead to an increase in intra-African trade, whilst 36% responded in the affirmative. Southern Africa actually appears to be more optimistic about the future of intra-African trade than the rest of the continent, with over 57% responding in the affirmative. In North Africa, however, 81% of respondents did not see the prospects of more intra-African trade across the three strategic supply chains. Move on to here. And we also asked respondents to give us an idea of whether they had noticed an increased request for security from financial institutions during the COVID crisis period. And 76% of respondents said that they had not seen an increase in requests for additional security to secure their confirmation lines, whilst 23% reported that indeed they were asked to provide additional security to secure their lines. On the regulatory environment, the respondents were asked to give us an idea of their ability to cope with COVID-19 related regulatory environmental requirements. And nearly 84% of respondents report that their LC operations were coping well or very well with regulatory challenges that were linked to the COVID-19 crisis. And just over 20% of respondents in Central and Francophone West Africa noted, however, that they were unsure about how their operations were coping. So that's yet to be seen. And nearly 24% of respondents report that their national regulators are constraining their abilities to respond to COVID-19 to a very high or high degree. And just over 64% of respondents, however, reported low or very low constraints. Now, regulatory issues are often cited as posing a challenge to assuring adequate trade finance globally. The survey reflects, however, solid coping by the industry despite a material level of regulatory constraints. So what are the summary key takeaways from this survey? The study findings have broadly support the narrative that COVID-19 affected the trade finance activities of banks across the continent, and it actually did lead to material disruptions to trade, specifically the LC business and correspondent banking services operations, which had witnessed a quite huge slump, which could exacerbate the continent's trade finance gap. While a significant number of respondents, either by size of bank or ownership structure, indicated an increase in demand for trade finance, it was rather instructive to note that the LC rejection rate increased, while at the same time, correspondent banking relationships were reduced or cancelled altogether. And in closing, domestic and privately owned banks also appear to be just as risk averse as foreign banks. However, while withdrawal of international banks in the face of heightened uncertainty could be part of the long-term trend, the relative increase in risk aversion by domestic banks is really viewed as something that is largely temporary and is driven by liquidity constraints and difficulties in accessing foreign exchange. And finally, in closing, government-owned financial institutions appeared to be the type of institutions that had more appetite for risk, and they were making significant contributions to try and address the liquidity flows during the crisis. The sharp contrast in risk perception between domestic, privately owned, and domestic majority government-owned banks suggests that other factors could be driving credit allocation and trade finance. Also, most LC cancellations and correspondent banking services withdrawals appear to be informed by a perceived high risk. A lot more must be done to address this perennial canker of risk misestimation, which leads to high risk premiums placed on African bank risk. At this point, I'll yield back to Dr. Luke. Thank you very much.
Thank you, Gwen. I'll now quickly summarize the interventions of the regulatory institutions and development finance institutions before I outline some issues for the way forward. In relation to the regulatory financial institutions, there were varying regulatory realities across the continent. At one end, some central banks and regulatory authorities took exceptional measures to facilitate the clearance of goods without paper documentation, some going as far as to make letters of credit, so LCs, an attractive settlement and a financing option from a cost perspective. On the other hand, some central banks and regulatory authorities remain wedded to paper-based requirements and, by choice or necessity, appear to be restricting the use of LCs to facilitate the flow of pharmaceuticals and foodstuffs. Regulators made other compliance, regulatory and policy changes to alleviate operational burdens on firms and financial institutions in the wake of COVID-19. In relation to the multilaterals and export credit agencies, we saw bold interventions by multilaterals, including development finance institutions, or DFIs, and export credit agencies, which took swift and bold measures to address urgent trade finance needs in the face of tightening financing conditions and deteriorating credit quality. Regional DFIs across Africa swiftly unveiled new facilities to alleviate liquidity constraints and sustain the growth of trade. This included, of course, Afrexim Bank through its Pandemic Trade Impact Mitigation Facility and the AFDB through its COVID-19 Rapid Reaction Facility. The liquidity provided by the DFIs to banks enabled them to remain solvent and maintain their lending activities to small and medium enterprises and households. Now, in relation to the way forward, the report identifies 7 key areas for action. And allow me, by way of closing, to quickly outline these 7 areas. First, increase correspondent banking relationships domestically and more support from regional development finance institutions. Local and regional banks across Africa need to enter correspondent banking relationships to take advantage of growth opportunities created by the exodus of large international banks from the continent's trade finance landscape. Africa's trade finance needs are significant and expected to increase even further during the implementation of the African Continental Free Trade Area. DFIs, already major actors, will need to play an even more important role, increasing their support to commercial banks engaged in trade finance activities. Second, more coordination and alignment of COVID-19 response measures is needed. Survey findings suggest that central banks responded to pandemic-related regulatory measures in an agile fashion, and that such measures do not constitute a significant impediment to the flow of trade finance. However, it is notable that a significant inconsistency exists at the regulatory and transactional levels. For instance, while some regulatory authorities took measures to facilitate the clearance of goods without paper documentation, others were less able to apply the same flexibility in the face of major disruption in international courier services. It would appear there is an opportunity to advocate for and perhaps facilitate greater alignment of pandemic response options across sub-regions, and in so doing, perhaps directly motivate greater intra-African trade and a more robust set of conditions for the post-pandemic recovery. Third, there's need for greater engagement between central banks and industry. COVID-19 and related challenges provide an impetus for central bank and capital markets regulators to engage with industry to explore the viability of creating new trade financing capacity via the participation of asset managers and private equity in directing capital to the financing of international trade, including South-South trade and African trade. Fourth, there is need for improved dialogue between governments and development finance institutions. This will create a framework and a mechanism that will reinforce dialogue between governments and the DFIs so that the DFIs continue to play a vital role of a front line in the fight against pandemic. Then fifth, there is enormous scope for a push for increased digitalization and an embrace of evolving financial technologies. While measures taken by central banks have been supportive of trade and economic recovery, they have been viewed largely as stopgap measures, with sample banks indicating that regulations within their countries have not been fully aligned with emerging technological innovation and major challenges facing their industry. The push for increased digitalization in the trade finance arena would alleviate some of the sector's regulatory concerns, help to increase efficiency and decrease costs. Banks and businesses across the continent also need to fully embrace evolving technologies which can extend trade finance facilities to informal traders and other small businesses. For example, online platforms, payment processors, and telecommunications companies could build upon existing business relationships and make use of their customer knowledge. The use of financial technologies in trade finance is still nascent, but it holds great potential to enhance the capacity and efficacy of trade finance providers to serve wider customer bases, while also reducing both the risk of liquidity constraints and the current excessive reliance on hard currencies for cross-border trade. Another example, of course, is the Afrexim Bank-led Pan-African Payment and Settlement System, which is both innovative and timely. For technology to realize its full potential, coherent and coordinated action, especially from the regulatory and policy angle, is required through broader stakeholder consultation. Then sixth, there is need for more reforms and reliable data. Creating an environment conducive to the expansion of trade and trade finance in Africa will require broad cross-sectoral reforms across the continent. Reforms to the banking and financial services sectors, as well as to the regulatory environment, would contribute to strengthening existing infrastructure, including technical infrastructure such as internet connectivity, and also including such related infrastructure. And of course, the available data also is key. The availability of data is also key to establish an environment that favors positive linkages between trade finance and trade in Africa. And then seventh, last but not least, as the survey results show, insufficient collateral and clients' creditworthiness were the primary reasons for bank rejections of trade finance applications in Africa during the first 4 months of 2020. The Afreximbank's Mansa repository platform, which provides a single source of primary data required for the conduct of customer due diligence on African entities, is an important step, but one that requires broad-based support at a continental level to have a greater impact on the financing of African trade. So these then are some of the policy implications stemming from the report that could be taken into account, and no doubt we'll be returning to these issues as the conversation now proceeds with the distinguished panel that has been assembled. So thank you very much for listening to both Gwen Mwaba and myself. Thank you.
Fantastic. Thank you, Dr. Luke. Thank you, Gwen. The report says strictly confidential at the bottom, but I assure you we will be able to share it with all participants and all those in attendance. So we'll make sure that the presentation we will share with you, as well as the report. It's no longer strictly confidential. It's all open to the public, and hopefully people will react and learn from it. So I'm going to call for my panelists to join me on set. So I don't know how the tech team will do that, but I'd like to call upon His Excellency Mr. Epsom Wanguta, from the Deputy Central Bank Governor of the Central Bank of Namibia, Madam Mervat Sultan, Chairperson and MD of the Export Development Bank of Egypt, Madam Bola Adeshola, Senior Vice Chairman, Africa for Standard Chartered Bank, and Amr Kemel, Executive Vice President, Business Development and Corporate Banking, Afreximbank. So protocol tells me that I should start with the Deputy Central Bank Governor of Namibia. But if I may, I want to break protocol and I want to go to someone who's dear to my heart, although there's no favoritism on this panel whatsoever, but I'd like to go to Bola. So the past 30, 40 minutes or so, we've heard a lot of different statistics. One that caught my eye when I was reading the report says that Africa's trading about $1 trillion a year, a bit more actually, about $1.1 trillion, but banks are intermediating $400 billion of that. So about 40%, I think the president of the Afreximbank said. Whilst the global average is about banks should be intermediating 80% of trade activities. So and he said something. He says trade finance is underserved on the continent. So my first question, very simple question: do you think it's underserved or not? And if it is underserved, are we missing an opportunity here?
Well, thank you very much, Omar, and thank you for inviting me to this panel. And I'd like to commend the Afrexim and UNECA and the other two organizations for the report. In terms of whether trade finance is underserved on the continent, I don't think so. I believe that banks, continental banks, and obviously with support from the multilaterals and DFIs and the global banks are providing finance. What I think it is there enough business and trade being driven? Because finance will support demand. But the key thing is, what are we doing on the continent to facilitate increased business and increased need for trade, both trade outside the continent and intra-Africa trade? So a simple answer to your question as to whether it's been underserved is no. It's not so clear cut. But what I believe we could be driving more is trade and business activities across the continent.
Okay, fantastic. So I'm going to get back to you in terms of correspondent banks, and there's lots to say around that. But now I'd like to go back to His Excellency Epsom Wanguta. I mean, I don't want to say the report is critical of regulators, but from what Dr. Luke has just said, is he feels that regulators could be doing more ultimately. I think it was either Gwen or Dr. Luke said regulators are or the banks that were surveyed said that regulators are constraining their ability to respond to COVID. I think if we've seen anything, actually, we've seen the power of regulators this past year. And if anything, the regulators have acted positively in a very quick fashion. So I don't know, maybe they're getting, they're not necessarily constraining, but are we seeing, what's your take? Do you think regulators could be doing more? And also, I had another question. What's your take in terms of the widening trade imbalances and the FX liquidity shortages? Are these an issue that you're having to deal with and contend with?
Thank you very much, Omar. I should really thank those who have spoken before us, because more or less they have really set the stage for our intervention, and also the survey results that were presented. I think they really have highlighted quite a number of things that are facing us and challenging us in a continent, which really need some kind of coordination from all the players, including the central banks as regulators. Just coming back to the question that you have posed, I should really say that COVID-19 pandemic has impacted the global economy at an unprecedented scale. Namibia as a country has not also been spared from this. We realized that our economy in last year, 2020, it contracted by around 8%. That is the first ever deeper contraction that we have seen over the last 30 years. Most of the key sectors of the economy, they were severely impacted. Sectors like tourism almost contracted by more than 70%. So that's really what we have seen. And when we realized this, we took some kind of measures. We look at two levels of intervention. The first one was, of course, what the central bank do, monetary policy. And then the second level that we look at is more of an unconventional relaxation of regulatory measures or regulatory requirements. So these are the two things that we have done when we realized that we needed really to do something to mitigate the impact of COVID-19 to our economy. What we have done in terms of monetary policy, for the whole of last year, we maintain an ultra accommodative monetary policy. We cut the repo rate of the central bank by more than 275 basis points. So that the accommodative monetary policy stance, what we have taken, we believe that was really able to support the economy in a way. In an ordinary fashion, if you have cut interest rate to that magnitude, it was really going to have quite a very strong impact in terms of the capital uptake. But because of the intervention of the measures that were also taken to contain the spread of the COVID, businesses were closed. So the impact of the accommodative monetary policy did not really have the desired effect as we wanted to see. I think that's really one of the things that we have noted. And then in addition to that, the second measures that we have taken is with regard to the relaxation of the regulatory requirements. These measures were taken again to support the banks to be able to support the broader economy, including trade finance. What is it that we have done? We instituted what we call is a loan repayment moratorium, meaning to say that we introduced repayment holiday and that resulted in a loan amount getting relief to the tune of around 689 million US dollar. So that's really what we have done over a period of around 9 months. And also we went a step further. We implemented also a relaxation in terms of the write-offs. Usually when there are delay payments, banks, there are standards that as to when to write off and to do provisioning. As central bank, we did some kind of relaxation on that. We also allow banks in terms of we relax as well. We have given them liquidity relief measures and also capital conservation buffers. All these measures were taken to fully support the commercial banks to be able to support the economy including trade finance. Other measures that we have taken as a central bank is also relax the concentration limits and also the exposure to a single entity. So these are the couple of measures really that we have put in place to make sure that the economy is well supported. Maybe I can stop there in terms of the intervention that we have taken. Of course, in terms of the shortage of Forex, what we have seen, because there was a slowdown in trade generally, especially for imports, that did not really affect our level of reserves to a greater extent, because import has gone down quite significantly. And then there was not really such a huge demand in terms of the Forex. So we did not really experience a shortage of Forex to that extent.
Okay, that's very interesting. Thank you. Thank you, Excellency. That's very interesting, actually, because I remember looking at the statistics for Tunisia, which is where I'm from. And the first few months, I haven't checked them recently, but the first few months are April, May, June. So there were two factors. There was the price of oil went down because of the dispute between the Saudis and the Russians, and the global slowdown. So import of oil products fell. And as you rightly say, other imports also fell because consumption fell to some extent, which meant that the actual balance of trade or the trade balance improved over those 2 months. But the report actually says one thing. It says that the liquidity crisis, if not handled properly, could morph into a solvency crisis. So you mentioned some industries that were struggling last year, and Dr. Vera Songwe also said that what banks may see are rising NPLs, for example, this year, which may create more problems for the banks. Is this something that you're anticipating, you're seeing, or you're worried about?
Thank you very much, Omar, for that question. I think what we are really seeing at this stage, banks have really been, when we look at our bank, of course, before the pandemic, our banks were well capitalized, the liquidity were at the right level, the capital conservation buffer, they were maintained at a high level above the regulatory requirements. But certainly what we have seen asset deteriorating. Before COVID, the non-performing loans was just hovering around 3%. Now we see non-performing loan hovering in the range of 6%, and in some banks around 8%, almost getting close to around 10%. At least it is an area that we are worried about. We need to monitor it closely because we do not know the extent to which COVID is going to persist. If COVID-19 really persists beyond, say, another 18, 24 months, then suddenly we will start seeing an impact on the financial sector. So what we are really hoping for is for this pandemic, although it has really affected the real sector so much, our hope is that not really to spill over to the financial sector. We know that the financial sector has been affected, but we do not really want to see a huge impact and spill over to the financial sector, because that can really be disastrous.
Fantastic, thank you. I've got a lot of questions for you, but let me move on to another panelist. I'd like to go to Madam Mervat Sultan. So first of all, I mean, Egypt ultimately is a counterexample, because I mean, Namibia, the Deputy Central Bank Governor said experienced 8% fall in GDP growth, whilst Egypt is an exception to the rule. You showed growth last year, but tell me, are you worried in terms of the NPLs and what that may do in terms of yourself as a bank? Are you seeing rising NPLs at your institution?
Well, thank you, Omar, for the invite to this distinguished panel and that survey and the launch of the survey. Actually, Egypt is quite unique because, like you mentioned, we have not witnessed shrinkage. So we have witnessed a reduction in the growth rather than, negative growth. So it's about 2.8%, and again, probably expectation to come around 3.5% by the end of the fiscal year 2021. The thing with Egypt, in addition to the fact that Egypt is diversified in its economy, is the reform that has been going on not only since 2016 after the free float of the currency and stuff, but actually way before that, which has led to this sort of growth. So, but now to answer your question on the NPLs, I think the measures that have been taken by the central bank were quite strict, very similar to what His Excellency has been saying in terms of, repayment holidays for 6 months, and then each bank was left to discuss internally how to handle each client after, the repayment holiday was over. Now, what we did at the bank is actually right from the very beginning, we looked at each and every industry and each and every client within each and every industry, because the impact of COVID varies even within the same industry, depending on the size, the resilience of each client, so on and so forth. Those exporting, which markets they export to. So all these factors taken into account, we classified each and every client. We put a strategy for each and every client on how to manage after the repayment holiday was over, whether they needed rescheduling, stretching, converting some of their short-term facilities into medium-term loans, so on and so forth. But as for trade, what we've actually seen, and I think that's in line with what has been going on in the country, is that we've seen about overall 7% increase in exports in the country. Our market share, or the volume of trade that we've done, exports specifically, has also gone up by about the same percentage, 7%. So that shows, the banks, we're not the largest bank, but we're a medium-sized bank. But I think the trend is the same in all the banks. So we've seen trade finance functioning properly. Basically, even while lockdown, exports didn't stop because the ports were working, the airports were functioning, maybe not for passengers, but for cargoes and so on. So all these measures helped, to stimulate, I think, the amount of growth that we've seen.
Okay, and tell me, the report said that banks had reduced the number of letters of credit that they were issuing because of creditworthiness and more the demand for more collateral. What's been your take on that front?
On Egypt specifically, I think we were not impacted by that type of measure taken by foreign correspondents. In general, we enjoy lots of credit lines that were not cut back. We haven't seen a reduction in the letters of credit. Actually, in some cases, due to the situation globally, you would see a change between, documents for collection into LCs. So the combination between both has still been balanced in a way that we've not seen a reduction, we've not seen a cutback in lines, we've not seen even a reduction in the correspondent banking relationships. So for Egypt, and I think the survey also reflected that maybe North Africa specifically, there wasn't so much change in that situation. So for us, it was the same.
Okay, fantastic. Bola, if I could go to you very quickly. We just mentioned correspondent banking. I mean, the survey says that, I've got it here, 47 correspondent banking relationships were cancelled between January and April 2020. The majority of those from European banks. So what's your experience in terms of, I mean, you work for a global bank ultimately with a large presence in Africa. So you're seeing both sides of the story, so to speak, the African side and the international side. What are you seeing with correspondent banking in general? And is it a worry for African banks?
Well, I would say that generally, and following on from what Mervat said, it again depends on the creditworthiness of the institution that has the lines, and of course the general risk rating of the sovereign, the country. For us as a bank, I mean, we've been on the African continent for over 100 years, and we are a commerce and trade bank. So we don't shrink, we don't retreat. What we do is assess the situation, and that's exactly what we did. I mean, clearly the credit environment was stressed, and there were other factors as well, fraud risk, cyber risk, and so on, going on during a period of crisis. And then, of course, compounded by, portfolio investors moving out, the FX liquidity challenges, and so on and so forth. But, as an institution, what we did was, how could we support our clients? Because it's really all about the clients and about the business. And the bank acts as a facilitator. The outcome of the crisis is not materially different from previous crises. It is how do banks position themselves to continue to support their clients, as in the financial institution that we give credit lines to, and our clients as well, who are the businesses. So for us, it was really, the initial reaction was to determine the extent of, we stress tested our portfolio. We looked at the institutions that we had lines for. We didn't cut back. But the initial thing was freezing where we were until we were able to assess the individual institutions' response to COVID, their credit portfolio, and so on. Again, in terms of our role in trade and also in correspondent banking across Africa, we focused on how we could help the clients through the technology route. Getting them more digitally savvy and getting them on technology platforms that would facilitate their businesses. But overall, we're fully invested on the continent for the long term. And so, crisis will come, crisis will go. But the key thing is, how do we partner with our clients? How do we ensure that the banks are still able to support their own clients, and then ultimately the individual companies that we deal with.
Okay, you mentioned portfolio outflows. So, and the report does mention actually that April 2020, especially this time last year, we saw massive capital outflows. But has the situation been remediated? Are we seeing this capital flows coming back into the continent, or is it still too early?
Again, it's a country by country basis. I believe that capital flows are coming back gradually, particularly for portfolio investors, also a function of their ability to repatriate, at the end of the investment cycle. Where there has been FX liquidity challenges, I think investors have been a bit more cautious in investing in certain countries or certain parts of the continent. But in countries that where the regulators have been able to intervene appropriately, support the currency, intervene in specific sectors, and some of the things that Epson had mentioned, we're seeing portfolio flows coming back gradually. Yes.
Fantastic. Okay, and we're going to talk about digitalization in a second with all of you. But first, I'd like to go to our good friend, Mr. Amr Kemal. So the good news is that Vera Songwe is asking for the bank to be the bank's capital to be increased, which is music to your ears, I'm sure. Absolutely. But tell me, so tell us a little bit about the interventions. I mean, the report does say that banks, regulators, i.e. governments, and DFIs need to work more closely together to contribute to the bounce back, to the economic rebound and to support economic growth. So tell us a little bit about the interventions that the bank is doing, and what more can we do? What do we need to do? How do we need to think differently about these solutions?
Right. Thank you very much. I think, at Afrexim Bank, over the years, we have been getting sort of accustomed to designing facilities that are sort of counter-cyclical in order to sort of deal with the problem of member countries absorbing global shocks, whether it's because of commodity-induced shocks or natural economic cycles. So, for example, you recall in 2015, 2016, when the so-called commodity super cycle came to an abrupt end and crashed, we designed a program called Counter-Cyclical Trade Liquidity Facility at the time, what we dubbed COTRALF, and disbursed close to about $10 billion in just over 2 years, or just actually under 2 years. So I think when COVID hit, we were sort of quite ready and very quickly developed the Pandemic Trade Impact Mitigation Facility, which, even though initially we approved sort of $3 billion for that, we found a huge sort of uptake of the facility. So we quickly worked with partners, the likes of the ITFC, our friend engineer Zombol was here, and many other DFIs to sort of scale up the facility. And so far we've managed to disburse up to about $6.5 billion. and we still have about a billion in the pipeline. So there's still very much interest in that. Now, obviously, the rollout of that facility has considerably ameliorated the impact of the COVID in many of our member countries. But I think there's still more to be done. And as Dr. Songwe mentioned, the critical thing now is to have as many people as possible vaccinated so that we get this COVID out of our way, because we're clearly not out of the woods yet. So this, I think, in partnership with the UNECA, the African Union, and the Africa CDC, we again worked on securing supplies of vaccinations for the continent, and we have managed to sort of provide some 400 million doses through a guarantee program, which Afrexim Bank will be guaranteeing. We've earmarked ourselves up to $2 billion for that, to ensure the speedy supply of the vaccinations with the suppliers. And then for countries that, once the supply is actually made, for countries who want to sort of have instrumental payments, we'll be able to provide that for them in terms of financing over a period of 5 years. So, and the principal reason for that is that even though we have the COVAX program, we're very commendable, that is aiming at only 20% of the population, while we know that in order to achieve herd immunity, you need to reach 60%. So it is hoped that that program will what we call the Advanced Procurement Commitment Program would also help in achieving or reach that 60%. But I think this is this is a sort of short-term measure. Clearly, what has been observed is that most of the countries that are producing those vaccines have sort of like the Trump thing, America first. Everybody's now saying, I will get my people vaccinated first, then we look to others, which is, I guess, I don't know if it's normal human nature or not, but so the clear lesson that we have to learn really is that Africa has to start providing its own, vaccinations. It has to start processing its own manufacturing and development of vaccines. And we are already working with, again, partner DFIs to make sure that we provide, there are a couple of facilities in Africa that can scale up and provide vaccines or manufacture vaccines locally. So I think that's now going to be the next step in that we're targeting to make sure that we provide that capacity. I think these are the major things that I can say. Of course, again, Dr. Sondu mentioned the African Medical Supplies Platform, that is used as a gateway basically for all those orders to be made. We're also working with UNECA on the supply of production of essential medical materials, the PPEs and the like. That again was part of the PATINFA initiative. I think one thing that came out of this, this experience, as bad as it was, but really it has really strengthened tremendously the collaboration between regional DFIs, international DFIs, of course the IFIs, the World Bank, the IMF, governments, central banks. I think everybody really came to the fore, and especially in Africa under the African Union. I think a tremendous work has been done, and the collaborative effort was really very, very commendable. I think I'll pause there, and then maybe if there's anything else.
Thank you, Amber. As we know, all of the people on this panel are under 40 years old, so we're not part of the priority group for vaccinations yet. But you mentioned a number of very interesting points, actually. One that which Bolo also mentioned, and ultimately, indirectly, Madame Sultan mentioned. I mean, if Egypt has done well, it's largely because of its circular economy and diversification of its economy. What you're calling for ultimately, we need to be self-sustainable in terms of the continent, in terms of our own medical products, our own healthcare solutions. and we need to develop industry. But my question to you, so I know that you've assisted governments, you've created these counter-cyclical facilities, but in terms of the business from the trade finance business that you were doing with other clients, has that gone down or gone up last year? What's the mood on that front from your clients, from your traditional clients during non-crises?
No, I think for us it's gone considerably up. Perhaps because we're working on a continental body, so this geographical variations, we're maybe getting more supply demand from the countries that had worse sort of uptake, or those that were getting those credit lines being cancelled that were mentioned in the study. So I think, yes, overall we've had a large uptick. Of course, Patinfa contributes considerably to that, but even the normal trade finance requirements that you said have gone up, I think, more than 30% last year. We had, currently we operate on the basis of 5-year strategic plans. So our current strategic plan, which is dubbed Impact 2021 Africa Transformed, one of the pillars we have is trade finance leadership. Now, that is obviously not the typical trade finance. It was primarily because of what we've seen even prior to COVID, where many of those international banks were pulling out of Africa because of so-called high compliance costs and so on. And so some of the programs and facilities that we designed under this trade finance pillar, we have things like AFTRAF, the Afreximbank Trade Facilitation Program, which is primarily to provide local banks with LC confirmation lines, RUs, and so on. We also have the Afreximbank Guarantee Program, AFGAP, which is again for to provide risk-bearing facilities for FIs, for governments, and so on. These two programs had considerable uptick in 2020, which obviously again goes to demonstrate the importance or maybe the large number of curtailment of LC lines and correspondent banking facilities. So I think, we had, over $2.5 billion in those two facilities alone last in 2020. So I think overall, like I said, yes, there's been quite a considerable demand from our perspective.
Okay, that's good. That's good. Maybe I'll go to Madame Sultan. So Bola mentioned digitalization ultimately, and trying to encourage clients to be more digital savvy, and hopefully through digitalization we'll be able to reduce costs, reduce friction, and hopefully increase transaction flow. So what's your experience there? Is this a solution, and do you have to work with the regulators? Whose responsibility is it to drive this digitalization?
Actually, I absolutely agree with what Bola has said, because digitalization fast-tracked, that was one of the very positive outcomes of COVID. So as bad as it has been, there have been positive things, and technological advancement and digitalization have actually been one of the good outcomes, mainly driven, yes, by the regulator, because we need to have in place the regulations as well as the legislation from a country perspective in order to be fully digitalized. And I think this is also something, if we talk on the Egyptian level, this has been going on and talking about the e-government in Egypt and encouraging digitalization and the use of less cash and applications, financial technology. So even within the banks now, you have a lot has happened throughout the past year. Many banks are now able to use different digital channels to reach their customers rather than just the traditional branch network accessibility, because at some point, during COVID, the hours were reduced. And so it was actually very, very good to have those digital channels activated and intensely used. I think we've seen as a bank for ourselves at least 25% increase in the number of transactions that have been done on a digital sort of way. In addition, we've also applied the robotic processes in order to automate a lot of the processes and be able to cope with the increased number of digital transactions coming through our way. So yes, I do agree. This is an incredibly important trend. It will keep on going further because we believe this is the future. So while physical presence is still important, and at a certain level, you need to have coverage in the country because not everybody would be able to go digital. But at the same time, in parallel, you really have to go through digital transformation and adding on many services to your digital offering. And that's what's been happening a lot in Egypt.
Fantastic, thank you. Look, we're running out of time, so I'm going to ask one question to His Excellency Epsom, and then someone actually sent me some questions via email, which I'll raise with the panelists, one of the participants. But Your Excellency, Mr. Wanguta, I think it was David Luke said that central banks, so one of the recommendations was central banks need to engage with industry to get asset managers and private equity to finance or to participate in trade finance activities. So what's your view in terms of working more closely with industry, changing regulations so that we can unlock some of that domestic pools of capital that we've got, so that we can close that trade finance gap?
Thank you very much, Omar, and thank you also for the participant who asked for David Locke, who raised that issue. Of course, as a central bank, I think we have got a channel, usually the channel that we use when we are creating capital or are creating liquidity in any country. We go through certain channels that are established, and we go through entities that are falling under the regulatory ambit of the central banks. In this particular case, the entities that are falling under the regulatory ambit of the central banks are commercial banks and asset management and other entities. Those are not really falling directly under the central bank ambit of regulation. So it is something that can be explored, but as far as I'm concerned, what we need to do, I think we still need to explore. Commercial banks have been doing trade financing, but possibly there is still a scope for improvement. There is an area for improvement. We can do better. They can do better than that. So possibly what we need to explore before we move on to the asset management companies to do that work, we still need to explore what is it that commercial banks can do more that they are not doing now. If there are any regulatory impediments that are coming from the central banks, possibly that we need to revisit. So I think possibly we need to look at it from that perspective before we explore other avenues that are a bit unfamiliar.
Fantastic. So in a second, I'm going to call engineer Hani Sonbol from the ITFC, part of the Islamic Development Bank, who's going to comment on everything that we've said. And he'll be joining us in about 1 or 2 minutes. So, but I'm going to get Bola to answer that question. What can central banks do more? And I've got a question here from Dr. Jaap Smit, who's at the Ministry of Foreign Affairs of the Netherlands in the Sustainable Economic Development Department. And he says, if the default rate is very low, why can't African banks make more trade finance available? So Bola, that's to you, please.
Yeah. Well, again, default rate is relative. So when we say default rate on exposures, different countries have different thresholds. As I said earlier, African banks, to a large extent, are constrained by liquidity. They are constrained by the correspondent banking lines that they themselves can have for trade transactions. But I think that the way forward is really partnerships. Increasing partnerships with DFIs, looking at how blended finance, for example, can be used more effectively, ultimately helping the customer both in terms of pricing, tenor, and so on. Again, like I said, technology, because if you reduce the costs, ultimately, it's easier for the client. But I think that partnerships is one way, and then also I guess the sort of overcoming regulatory hurdles as well. The more cumbersome, the cost of compliance really is also a challenge for many African banks, and sometimes even just the uncertainty of the regulatory environment. And when that happens, you find that the first thing is for banks to be cautious in their exposure. But I believe that, and you haven't mentioned this at all, but I think the, Continental Free Trade Agreement and, the prospects of that, if implemented properly, should help facilitate more, intra-Africa trade and the ability of, African banks and African businesses to attract international capital to facilitate trade.
Fantastic. Thank you for mentioning that. Absolutely. So the tech team, if I can add engineer Hani Sonbul from the International Islamic Trade Finance Corporation to just join us and give us his comments on today's panel and what our panelists just said.
Thank you very much, Amar. Thank you for the kind invitation. And I just was really very much pleased that I joined you today, because we have learned a lot through the survey, which was really presented. And I think this is of course, this kind of work is done, can really pave, at least give us some sort of a visibility for where we are going. Actually, we all know that ITFC is very much worked really with all member countries during the COVID-19. However, I'm not gonna, of course, repeat the all these impact, which on member countries, but it was heavily impacted. Of course, the volume was, the overall global economy was also attacked on a multiple level and fronts from this pandemic, especially from the ranging from the full lockdown to where we are today. But I would like to say that maybe I will make it forward-looking rather than looking backwards, because that's where we should head actually in the coming phase, so to fight this pandemic. As we all know that the ITFC had also this 3R program, where we started really the response to the immediate needs of Africa in the beginning, and then now we are embarking into the new phase, which is the recovery phase, and that's very important to see how can countries come back and restart their economies. And this is where we are today. The first phase was very successful, and yes, despite of all the challenges mentioned also by the panelists here regarding the how markets were dry and how things were actually, did not last for long, but because it is normal whenever you have something like this happening, unprecedented pandemic is hitting the globe. Of course, things like this can happen, but we found that maybe from Q3 to onward, things got better, and we were actually very much optimistic about also the growth during the last quarter of 2020. And we have revisited our strategy in Africa, and we felt that now we have new sectors to really support. One of them is the health sector, more emphasis on the agricultural sector. And we will continue to also to support Africa in the energy sector as we did in the past years. But one lessons that we have also learned, that policy decisions were very important during the pandemic, and will continue to play an important role actually in determining the pace of the economic recovery in Africa. For the output and the trade to rebound strongly in this year, 2021, I think we all agree that fiscal and monetary and also trade policies will need to keep pulling in one direction, in especially this year. We, as I said, we are now repositioning ourselves in Africa. However, one of the also good lessons that we learned is that without partnership, we cannot really face what is the world is facing. That's why we strengthened really our partnership, and thanks to Africa Exim Bank for their continuous support and also for their partnership. We have been actually close to all partners, UNICA and the African Union, central banks, governors. I met almost with everybody during that year. It was so important during the year to keep in touch with all of the partners to really see what is happening and to try to put hands together. The 1.5 billion COPRIVA is really one of the results that we've had, and I'm sure that Africa will benefit, especially in the area of trade finance areas. So what just to conclude in a very short, I think where we should go now is to continue this dialogue, continue this communication and partnership, and also to because we recognize trade that will play a big and major role in the recovery, and also to strengthen and especially in the area of trade facilitation. Now, also we have to put our hands together to work on the vaccination. We started really now many trade financing transactions in the vaccination, and the vaccination is very important. As mentioned, we all have to ensure that this is really reached in Africa, especially in 2020, as much as we can. There are also opportunities that needs to be captured, but we need to remove the barriers. Bridging digital divide is becoming mandatory. We have already started now with member countries, especially in Egypt, we're doing a lot of digital transactions, trade transactions, and we tried really to help member countries close the gap in e-commerce. And other than that, of course, more relaxation is needed to, especially especially of the protectionism and closed borders. We need to really now open again, boost confidence in trade. That's very important in the coming period, and also avoid any restrictions. Without that, maybe I summarized all of this in the 2 minutes allowed for me, and I thank you very much again for your invitation. Thank you.
Engineer Hani Sunbul, thank you very much for that great summary. And I believe you're absolutely right. I mean, it's as Bola mentioned and as our fellow panelists mentioned, there's a power of collaboration. So technical team, if you can bring all the panelists back so I can thank them personally, thank you. Thank you all. We haven't had enough time, unfortunately, to make this conversation even longer and more detailed. There's so many points that I wanted to raise with you all. But thank you all for your time. Thank you all for your attention. I'm now going to call upon the architect of today's event, who's fully vaccinated, I can say. I won't tell you which vaccine, I'm not sure, but I know he's fully vaccinated, and he's been the one who's been the conductor behind the scenes and who recommended all of our fantastic speakers today as well. So I'd like to call upon Dr. Hippolyte Fofak, who's going to make the closing remarks. Thank you very much, esteemed panelists. It's been a great learning experience being on the panel with you. If we can bring Dr. Fofak, please, to make the closing remarks, and thank you all for participating.
Thank you, Omar.
Thank you.
Thank you, Omar, and thank you very much to all the panelists, and really, and all from all the contributors from all over the corner around the world for being part of this first launch of our Continental COVID-19 Trade Finance Survey. And really, it's a rapid impact assessment tool jointly put together by the FDB, UNECA, Making Finance Work for Africa, and Afrexim Bank, to essentially, as the president said, enhance our understanding of dynamic of trade finance in the wake of COVID, but also designing appropriate response for banks and institutions in the front line of African trade and promotions of African economic development through trade. I'd like to really thank all the panelists, and really, we are particularly grateful, and I'd like to thank our President Orama and Vera Sangwe for setting the stage so nicely, and for a vibrant exchange, the one that we all listen. And we are very grateful to those, my two colleagues, who provided a nice overview of the report, Gwen and David. and really for our high-level panel, and Dr. Epson from Bank of Namibia, Meva Sultan, Bola, but also our EVP, Vice President Amkamal, for the insight on trade finance and such an important and timely topic, critical for the post-pandemic recovery, but also long-run growth and structural transformations of African economies. Countless insight and perspective and discerning question emerge from the rich and vibrant exchange, and perhaps reflecting the importance of trade growth for the recovery in the post-containment phase, but also insignificantly, the importance of trade finance for economic development in a region where, as the president said, trade financing gap remains stubbornly high. And trade finance is indeed the lifeblood of commerce. And today, event provide opportunity to reflect on the extent to which the economic and financial fallout of COVID-19 pandemic have affected the supply of trade finance across the regions. And several challenges were highlighted by the different panelists in the report: increased rejection of LCs, correspondent banking, and risk aversion by domestic privately owned banks as well as foreign banks. But the panel also highlighted several key messages, not least the correlation between the bank ownership structure and the degree of risk aversions. And while privately owned bank and foreign bank were actually exiting the African trade financing landscape, going pro-cyclical and in the process making the crisis worse, government-owned institutions expanded their support, alleviating liquidity constraints, boosting African trade and softening the blow in the process. And through the counter-cyclical support and continental institutions such as Afrexim Bank and the AFDB were in the latter category, as our EVP articulated in his remark. They were less risk-averse and worked closely with government and central bank to provide bold and timely support to African banks and institutions. Several questions emerged from that contrasting risk perceptions, which I'd like to pose on the table as we reflect on the post-event. Is the increasing risk aversions of private and foreign banks the result of sudden inflation of perception premium, or increasing liquidity constraints in the context of tightening global financing conditions? That's the first question. At the same time, the COVID-19 pandemic downturn ushered in a new era in the space of macroeconomic management, where we saw African Central Bank moving away from the single objective of inflation target toward a dual objective of price stability and growth. And the question is, what role will African Central Bank play in the promotion of African trade and economic development in the post-COVID world? At Afrexim Bank, we do hope that the dual mandate revealed by the COVID-19 crisis is here to stay, and that will be the way forward as the continent contemplates growth and development. The contrast between global bank and international financial institution was also very instructive. Where most were deterred by the challenging financing environment of sharp deterioration of commodity terms of trade and heightening balance of payment pressure, some saw the need to support the recovery process. Africa will remember these loyal and faithful partner institutions, which are always there for the better or worst. A real love story is what we need at this stage. And we hope, and we very much appreciate the fact that Standard Chartered Bank played that role in the process. Looking ahead, there are important challenges. The post-COVID-19 world will be one of accelerated implementation of the AFCFTA for greater resilience to future global shocks after the 2020 great disruptions. Financing, both short and long term, will be critical for the AFCFTA implementations and transformation of African economy to reduce risk associated with commodity price cycle, which have been the main vector of liquidity constraint across the regions. Enhanced collaboration between banks and financial institutions through risk sharing and co-financing has been key to the COVID-19 crisis management. And as Engineer Sombol said, and as the President also insisted, we've seen a lot of collaboration between ITFC, for instance, and Afreximbank in that regard. And through Patimfa, bank has actually achieved one of the highest level ratio ever in just a few months, reflecting that effective collaborations. And that collaboration between banks will become even more important during the AFC implementations, a positive outcome that we should strive to sustain and even nurture in the post-COVID-19 world. And also critical, and as reflected in the panel discussions, will be financial innovations in the transition toward a paperless and cashless digital world to address liquidity constraints and reduce the transaction cost and eventually the trade financing gap. And Afreximbank Pan-African Payment Settlement System is an important milestone in that regard, and a strong support and commitment from African financial institutions and central bank will be critical for its implementation and success. Its potential benefits are actually significant for investors, traders, both formal and informal, banks, but also, importantly, central banks, especially considering its benefit for macroeconomic stability. Why do we need a dollar, euro, or yen that we do not always have to finance trade between Namibia and Kenya, between Nigeria and Egypt? Perhaps would significantly reduce these foreign exchange leakages and catalyze the emergence of sustainable solutions to one of the most important challenges on the African development trajectory, the financing of African trade and balance of payment pressure for the benefit of investors, bankers, and central bankers. Hence, the post-pandemic world could be one of the most exciting for African banks and financial institutions as they contemplate the end of the long tunnel of high perception premium and liquidity constraint. The success is within our reach, and the challenge posed by COVID-19 pandemic should galvanize all stakeholders, both corporate, sovereign, as well as external partner, as the President says. More than sharing their wealth of knowledge and lessons learned from effective COVID-19 crisis management, the panel outlined options and policies to sustainably ensure the supply of trade finance and transform African economies, going beyond crisis management to address our development challenges. Please join me once again in thanking them for the insight and expertise. I would like, on behalf of President, Professor Benedict Orama, to acknowledge all those who worked tirelessly to make this event such a success. The moderator of the session, Mr. Omar Ben Yeda, IC Publication Group Publisher, and his impressive team working around the clock in the lead up to the event. It all started with the survey design and data collections. I would like to thank all bank staff, central banks, for their support and contribution to the study. The entire team, and especially our partner from the African Development Bank, led by Stefan Letambi, and UNECA, led by Dr. Stephen Karengi, for their support during that data collection analysis process. Brand communication and all our media partners. Last but not least, certainly not least, our invaluable IT and technical expert and interpreter who are here to make sure that we are all on the same page, irrespective of the language. This event was recorded, will be aired on several news media outlets in the coming days. We'll be disseminating it along with a digital copy of the report to all those who registered for the event. We look forward to welcoming you again in our next event. In the meantime, I would like, on behalf of President Orama, to thank you once again for your continued support and commitment to transformation of African economy through trade. Thank you very much. Thank you, Omar.
Thank you, Dr. Fofak, for those great interventions and great summary. Your report only says confidential, not strictly confidential, so we'll share it with all the security services around the world, if you don't mind. I know they listen to you. I know they listen to what you say anyway. But thank you all very much for your attention and for being part of it. as Dr. Fairfax said, we'll be sharing a best of video and also the different reports and presentations. Thank you all. Have a wonderful, wonderful day, wonderful evening, and yes, let's support vaccination and let's support development and growth in Africa. Thank you all.
Thank you very much. Bye-bye.
Thank you.
Thank you. Bye. Bye, everyone. Bye.
Thank you. Thank you all for being.
Bye. Bye, Omar.
Bye. Thank you. Thank you, Professor. Thank you. Bye-bye.
Thank you, engineer. Thank you so much.
Thank you, Hebrew. See you.
Thank you so much.
Bye-bye. Adiz, take care.
Thank you very much.
Omar Kamil, thank you. See you soon. Bye-bye.
Thank you.
Bye-bye.